You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 18th of May 2025. I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing Imperial Brands, Auction Technology Group, Burberry, Sage, TUI, and our US company of the week is Upwork. John, do you want to start us off with Imperial Brands?
Yeah, no, absolutely. So it's the UK's second largest tobacco company. We've covered it on the show many times before. They had their half-year results out last week, with the group's first half underlying revenue rising by 3.2% to £3.7 billion before currency movements. Growth was supported by strong tobacco pricing, which more than offset a 3.2% volume decline. Sales of next-generation products were up 15.4%. Underlying operating grew by 1.8% to £1.7 billion, held back by a flat performance in the distribution arm, as well as increased investment in tobacco and next generation products. Underlying free cash outflows were broadly flat at around £500 million, and net debt fell slightly to £10.5 billion. Full year guidance is unchanged, with underlying sales growth expected to be in the low single digits and operating profit growth in the mid single digits. Imperial is rephasing dividends to be paid in 4 equal instalments, and on an underlying basis, the interim dividend increased by 4.5% to 80.16 per share, and £620 million of share buybacks or repurchases were made in the period. Stefan Bomhard intends to retire as the chief executive and will be succeeded by the chief financial officer, Lucas Paravinci, in October 2025. And the shares were down 6% in early trading. In terms of valuation, Imperial Brands has a market cap of £22 billion and trades at 8.6 times forward earnings, compared with the 10-year average of 8.8, and it currently yields 5.8%. I think these results were possibly actually a bit better than expected, in the sense that the volume decline is steadying a little bit now. I think we were getting used to it being mid to high single digits, and this was actually only 3.2%. Next generation products, again, pretty good, not shooting the lights out, but 15.4% certainly isn't bad. Net debt down a bit, but still got a fairly significant amount. It's interesting, the market reaction. I think that's largely down to the chief executive's plans to retire. He took over in 2021 and had a very different approach to Alison Cooper, who preceded him. She had really hedged the bets on investing big in the next generation products, and whilst Imperial aren't doing badly in them, they're certainly not leading the market in them, and they paid a lot for blue e-cigarettes back in 2014. It was around $7 billion, and that hasn't really paid off for them, but it was a lot of money at the time. He largely focused on it, I suppose, in a more conservative way, to a degree accepting that there is a lot of structural decline in the business, but from an investment point of view and from a shareholder point of view, decided to return essentially as much as possible to shareholders. And yes, investing, but most focused on returning money to shareholders, and nearly 70% was returned to shareholders since 2021 in the form of dividends and share buybacks. I think when you look at it now, by historic standards, certainly over the last 10 years at least, the dividend is much lower as a percentage. However, I think that probably does reflect a bit more of the stability and some of the share buybacks in terms of the total return to shareholders. Will much change? I suppose difficult to say. I would suspect that if they did follow a similar strategy to the previous one, the market may be overreacting a bit with that 6% fall, but it's very difficult to know. Sam, what are your thoughts on these results from Imperial Brands and the market reaction?
Pretty much identical, actually, without sounding boring. So, yeah, I think the volume declines of 3.2% is positive. I think the CEO retiring, although I don't think they've done a bad job, I know that the previous CEO does show what a difference the CEO's direction can take the business. But I'd have thought, like you say, if it's the CFO that was already there that's taking over, I'd have thought the strategy is going to be pretty similar. I don't think they're going to come in and really change things. And also, I think it's a relatively easy business to run. It's quite straightforward. You know what they're going to do every year. So I'm surprised the market reacted in the way it did.
Okay. On to a more dynamic company, perhaps. Auction Technology Group.
Yes, so it is. It's one we have covered a few times before now. But for anyone who isn't familiar, Auction Technology Group, well, they operate 8 digital marketplaces which target specific sectors and geographies, and it's mainly to do with, as you can guess from the name, auctions. So the marketplaces that they operate are Live Auctioneers, the salesroom.com, which is Europe's leading marketplace for fine art and antiques auctions, Lottimissimo, which is one of the leading marketplaces in Germany, Proxibid, bidspotter.com and bidspotter.co.uk, and ibidder.com. You can kind of think of them as an eBay, but just sort of specializing in the antiques and stuff like that. And they work more in terms of auctions that are actually still being done by like the auctioneers and proper auction houses. So not a Sotheby's or Christie's because they have their own online platforms. But if you think of your local antiques dealer or something like that, if they want to list stuff online, because they don't have the size to create their own platform really, and they wouldn't have enough people using it, they will piggyback off the sales rooms sort of infrastructure. So it's kind of like if as an individual you want to list it on eBay, if you're a proper professional auctioneer, you'd probably list it on the sales room because you know that's where people wanting to buy antiques will be going. So in the specific marketplaces it operates in, 56% of all bids last year originated on Auction Technology Group platforms. So they are the market leader. So Auction Technology Group have come out with their half-year results, and revenue was up 3.4% to $89 million, and they do report in dollars, driven by a strong uptake of value-added services and stabilization in gross merchandise value, with marketplace revenue up 4%. Adjusted EBITDA was up 8% to $38.5 million, with adjusted EBITDA margin of 43%, which was up 1 percentage point, driven by revenue growth and lower administrative expenses. Operating profit was up 43% to $15 million, driven by higher adjusted EBITDA, lower share-based payments charge, and no exceptional costs in the period. Operating profit margin was 17% in the period, and that compares to 12% the year before. So I did find that quite interesting in that we've got an operating margin of 17%, but an adjusted EBITDA margin of 43%. So which one do we go with? In the notes to the accounts, there's a reconciliation of profit before tax to adjusted EBITDA. So the main adjustments that they've made is they've stripped out share-based payments, which I don't really understand why you would adjust that out because that is a cost. I don't know why they stripped that out. So I don't think that should be stripped out. But yeah, it just because so much of the costs are the interest and the amortization, the adjusted EBITDA, I just think is pretty meaningless, really. So I'd be more inclined, I think, to stick with the operating profit than the adjusted EBITDA. I think the adjusted EBITDA, I know we're critical of it generally, but in this case, I think because interest and depreciation and amortization are such big expenses, it makes the business look a lot better than it is. So I think the operating margin of 17% is probably the figure to go with. They had strong cash generated by operations of $38.3 million, and that was up from $27.6 million a year ago. And the net debt to adjusted EBITDA ratio was 1.3x, which was down from 1.4x at the year end. They have launched a 40 million share repurchase program. Gross merchandise value, excluding real estate, was up 1% to $1.7 billion, primarily driven by continued stabilization in industrial and commercial end markets and a small improvement in the art and antique sector. Group conversion rate was broadly flat at 25%. They have also increased the take rate 0.1 percentage points to 4.6%, driven by continued growth in all 3 value-added services: auctioneer, paid for digital marketing, shipping, and payments. Value-added services revenue was up 14%. I think a take rate of 4.6% seems quite low compared to, what, albeit in different industries, other platforms charge. Considering as well with the take rate, they tend to take something off the buyer and the seller. So 4.6% seems incredibly low on the transactions. It's just 2.3% on each side. Although I guess their fees are sitting on top of the auctioneer's fees as well. So that might just be why.
Yeah. And they could be 20+% for buyer and seller.
I mean, it seems low for me, especially for those smaller ones where they are relying on the sales room to, get to a lot of people. In terms of the outlook, they said trading during the first 5 months of the 25 year was strong. Activity levels slowed in March due to uncertainty in underlying markets as trade buyers and consumers paused some activity to take stock of the global macroeconomic volatility. Trading subsequently stabilized in April. They've said that the tariffs may create both tailwinds and headwinds, making the future difficult to predict. And they've said that during the year they've executed well and that they maintain the full year guidance for revenue growth of 4 to 6% and adjusted EBITDA margin of 45 to 46%. And in terms of the valuation, the business trades at a PE of 32 and a market cap of £601 million. However, if you look at the free cash flow, it was 9 million in 2020. It was 10 million in 2021. It shot up to 46.5 million in 2022, 49 million in 2023, and then it's dropped slightly to 47 million in 2024. That is in dollars, but that's about 42 million pounds, and they've got a 600 million market cap. So that would put them at a price to free cash flow of 14. And that's basically, 47, that's pretty much, if you take an average of the last 3 years, you've got 46.47 million, 49 and 47. So it's pretty consistent as well. I think they've probably got scope to increase the take rate. It seems they're pretty well diversified globally. This isn't just a UK only story. And I think that PE of 32, previous times we've looked at it, that has kind of caused me to back off a bit, because it seems expensive and I struggle to know how big the market can get. I think at a price to free cash flow of 14, now that I've probably looked a little deeper for the first time, I actually think it's more attractive than I've given it credit for. The main thing that's distorting it really is that obviously the PE is based on the earnings, which is based on the net income. And that includes all the amortization for the acquired brands. They might go out and acquire more brands, but I don't think they need to go and acquire brands because the brands they've got will become obsolete. I think within, it's like the sales room. I think that's going to stick around. I don't know if that's one they built up themselves or they bought. But the point is, in 5 years' time, that's fully amortized. That's still going to be worth a lot of money as a brand. So although it's lowering the earnings, the sales room is going to be churning out cash every year. So I think that distorts it. So I actually think this is a business that's much more attractive than I've previously given it credit for. I think I might take a nibble at it, actually, on the back of this. What do you think, John?
Yeah, no, it's interesting. I think the point you make on the price to earnings and quite why it is as it is, and perhaps slightly misleading on the surface, is an interesting one. And probably at price to free cash flow of 14, it's not all that expensive. It's difficult to know how big the market can get, and that's something that I really don't know. Because I suppose you think about arts and antiques, particularly the antique side of things, having been pretty depressed for the last 30 years probably. So it's not exactly a growth sector, but I would be perhaps interested in digging into a little bit on some of those others, because if it's the auction technology itself, which is going into sort of more potentially niche or slightly growing sectors, maybe more of the art side of things, then yeah, it could potentially be quite appealing. And I know you mentioned that it's sort of not just UK based, and you've got Germany, you've got the US. It's a little bit more diversified in that sense too. So yeah, I think it's certainly one that I'll be looking at more, and probably the next couple of times that we cover it rather than right now. But it's certainly interesting, yeah.
I think at 14 as well, if it can just increase that take rate, you could still do pretty well on it. And I think there probably is scope to do that. I think as well, they are the market leader in what they're doing, but as well, there's going to be a chunk of the market where it's going to be like the Sotheby's and the Christie's, where they're always going to be on their own platform because they don't need to pay someone for the exposure because they're Sotheby's and Christie. There's not many of those, but if you strip them out and you actually look at market share, it must be really, really high. Because if they've got 56% of all the bids for everything last year in the markets they operate in, you add in Sotheby's and Christie's and maybe a few others, the equivalent in Germany that's really high end and stuff, And if you look at what's actually left, they must be pretty dominant. So, and then you look at those margins, because that's the other thing. They don't have to pay the costs of having, the experts checking the items or anything. The auctioneers do that. And they're relying on the auctioneers' reputations and stuff like that. They're not checking the items or anything. So they don't have the staff costs of that. But then I think that just means from a margin perspective, it is a business with the potential for much higher margins. Even if we use the adjusted EBITDA margin, which I think is generous, because I think interest is a real expense, whether you like it or not. But that's 43% after you strip the interest out. So how much higher could that go? I think there's a lot of scope to get the margins up as well as increase the take rate. And then you've got potential expansion into other markets as well.
Yeah. So we won't spoil pick of the week, but shall we move on to the next company?
Well, we've got a few good ones this week, but what's next? We've got Burberry.
Probably not, with no spoilers, but so it's the British designer. We've covered it on the show before. They had their full year results out last week, with full year revenue falling by 15% to £2.5 billion, ignoring exchange rate impacts. That was driven by declines across all regions. Full year comparable store sales were down 12%, with a slower rate of decline of 6%. Consensus was minus 8% in the fourth quarter. Underlying operating profits fell 88% to £26 million, compared with the £16 million expected, excluding the impact of £29 million restructuring programme. Free cash flow rose by £2 million to £65 million, as cash inflows from running down inventory levels helped to offset the impact of lower profitability. Net debt after lease liabilities remained broadly flat at around £1.1 billion. In 2026, Burberry expects to deliver margin improvement, helped by continuing cost-saving initiatives. No full-year dividend has been announced, and previously for 2024 it had been 61 pence a share. And the shares were up 9.2% in early trading. In terms of valuation, Burberry has a market cap of £3.6 billion and trades at 1.2 times forward sales, compared with a 10-year average of 2.37. And as I mentioned before, it's not paying a dividend. I suppose the slight positives in terms of the late improvement seems to be as a result of a change of strategy from the new chief executive, Joshua Schulman, and he's supposedly going back to basics, focusing on the outwear first, and apparently there's been some good responses to the marketing campaigns. I think that's really all that can be said that's positive from it. I think it's overall the direction that it's been going in over the last couple of years has been really concerning. Obviously, the macroeconomic situation, particularly in the last few months, hasn't been particularly helpful, but it wasn't exactly doing well before that. I think I'd given Burberry a bit more of the benefit of the doubt when we first started covering it, and it does have that attractive feature that it's been quite popular in Asia, but still it hadn't fully penetrated it, and you thought, well, if it could deliver growth there, then it could be absolutely huge. But I think that has been the case, or that's been the investment case for a long time, and we haven't really seen it deliver on that. And what's worse is that it had been putting up these numbers and really been struggling. I think we've also reflected on it, and as a brand in comparison, and this is probably an unfair comparison, but if you looked at the other end of the scale, LVMH, Burberry is so far away from that, and it doesn't have a portfolio within it. It's just Burberry basically on its own. And, in the past, they have had brand issues, particularly in the UK. They did do a successful rebrand. But again, even probably 15 years on, maybe even 20 years on from that rebrand, we're still yet to see the results. And what's happened in the last couple of years, I think, even more concerning. So I would definitely not be touching Burberry, even if it was looking at it kind of as a value perspective. And debt, 1.1 billion is quite a lot. So not for me. Sam, what are your thoughts on Burberry?
Really similar. The debt's concerning. I mean, we've seen it before, businesses like that. I don't want to compare it to Ted Baker because it's not quite that bad, but it's like the debt can build up very, very quickly. I know they had positive free cash flow, but that's because running down inventory levels, that's not something that can be repeated unless the sales drop by so much that they don't need that inventory either, which isn't a good thing. But yeah, really, really tough for them. I don't think it's a business I'd be interested in at any price because I feel like I'm not really clued in enough of kind of brands and stuff. And this has really proven that actually, because I probably 2 or 3 years ago thought it was a higher quality brand than it was. With Louis Vuitton, I don't feel that way because they've got such a good portfolio of brands. So that kind of de-risks it a bit. But I know it's a bit different, but it's like we were talking a couple of weeks ago about the ABF results. And I was saying on the back of that, I might take a position. I then bottled it and didn't buy it. But the reason was when it came to it, I just thought, well, after the experience I'd had with Boohoo, as good as ABF is, I don't want any more retail exposure. I think I wouldn't get into Burberry at any price anyway. But yeah, it is really concerning because I don't think they really have a plan. I don't. Yeah. It might turn around, but you could quickly end up in like a Boohoo Ted Baker scenario. And I think that's just why it's so tough in retail because it is absolutely ruthless.
I mean, you might actually find that Mike Ashley comes in for at some point.
You just beat me to my next point. But yeah, that's when you know it gets really bad when you started buying shares in it. But yeah, I wouldn't touch it.
Yeah, no, fair enough. Okay, on to something that's a bit more, well, close to home for you at least.
Yes, Sage Group. So for anyone who's not familiar with Sage Group, they do finance, HR and payroll software. They're probably best known for the accounting software. They do Sage, which is very well used in the accounting profession. And they have, according to their website, a large and growing total addressable market in excess of around 35 billion and very globally diversified, which again, for a FTSE business is pretty good. So 45% of their revenue comes from North America, 29% from the UK, Ireland and Africa, and 26% is from France, Iberia and Central Europe. I think we have covered them once before on the show, but it's not a business we cover often. I think because when we did cover them, we weren't overly impressed. And just anecdotally, I mean, I don't work with them directly because I don't use accounting software, or very, very rarely use it because my day job is in personal tax rather than on the accounting side. But from the colleagues sort of in the office and stuff over the years that have used it, the general feedback is that they're better than QuickBooks, which in the UK is one of the main rivals, but they're not as good as the Australian company Xero. The general consensus is that Xero it just has a better product than Sage now. That being said, what's good about this industry is that if you want to move something, they don't really let you take a lot of the previous year's stuff with you, where it's like you have to re-put in all the data of someone else. So that does make them very, very sticky because if you want to change your accounting service provider, it's really difficult because you lose all that data unless you're willing to input it and it'll be connected to your bank feed and stuff. So just moving it over to another provider is really, it just is a hassle. So anyway, Sage have come out with their half year results to 31 March 2025 and revenue was up 8% to 1.24 billion with annualized recurring revenue up 10% and operating profit was up 18% to 255 million. Underlying EBITDA was up 14% to 334 million and that gives an underlying EBITDA margin of 26.9% and that compares to an operating profit margin of 20.5%. Underlying basic earnings per share is up 17% to 20.8p a share and the underlying cash conversion is down 12% to 115%. They've highlighted their robust balance sheet with 1.2 billion of cash and available liquidity and net to underlying EBITDA of 1.5x. The dividend was up 7%, 7.45p a share and the buyback program was extended by up to 200 million. They had growth across all regions and that's balanced between new and existing customers, which as a shareholder would be exactly what you want to hear. And the renewal rate is down 1% from 102% to 101%. And that's measuring the renewal rate based on value. Sage Business Cloud revenue increased by 13% to 1.02 billion. and that includes cloud-native revenue growth of 22% to 425 million. Subscription penetration increased to 83%, up from 81%, driven by growth in subscription revenue of 12% to 1.031 billion. They said the rapidly scaling Sage Copilot, a generative AI-powered assistant, now available with key products in the US, UK, and Europe, delivering enhanced productivity and insights to customers. For the outlook, they've said against a background of a more volatile and uncertain macroeconomic environment, we currently continue to expect organic total revenue growth in the 2025 financial year to be 9% or above. Operating margins are expected to trend upwards in the 2025 year and beyond as they focus on efficiently scaling the group. In terms of the valuation, the business trades at a PE ratio of 32 and has a dividend yield of 1.64%. I actually think for the size of the business, these are a really good set of results. I think it looks like a quality business. I never looked further last time we covered it because of that anecdotal evidence. I think I would still have the same concerns now, but it looks like a quality business. And, equally, maybe it was a mistake on my part. I could have, if I'd worked in a different office, there probably would have been people saying that they preferred Sage to Xero. But based on my own anecdotal evidence, when we last covered it a couple of years ago, I didn't look any further. I think since then the share price is up by about probably 50%. It is still growing at a good rate, but I just think for a P of 32, I'd need a lot more conviction. So for me, it does look like a quality business, but it's not one I'd be interested in investigating further. What about you, John?
Yeah, no, I think excellent results. Well, there are lots of things to like about it, including quite how sticky it is and all of that recurring revenue. I suppose you've got the growth from the cloud and other services that you can add on to it. The thing that I was just thinking as you were talking about it is we've never actually covered Xero. I think it is listed, and that might be,
it's because it's in Australia.
Well, that's what I was going to say. It might be our first.
Cover it.
I was going to say it might be our first Australian company. I mean, we did cover BHP, and that relisted, but I don't think we've covered it since it relisted or since it moved over. So maybe what we should be doing before thinking further about Sage is actually get Xero on and dig down into that a little bit and do some comparisons.
All right, so I've just looked on Yahoo Finance for Xero. Now, I'm sure there's more to the story than this, but the first thing is PE ratio of 135.
Okay.
There's got to be something wrong. The earnings must be reduced or something.
It's relatively new actually as well. So Xero is only founded in 2006.
It doesn't, see, that's the problem as well. It does technically have earnings, but it had earnings for the first time in 2024. And then, that's why. So it's only just started generating earnings. So it's one of them businesses where it's just been reinvesting everything into sales, and it has been growing. Well, it's been growing a lot better than Xero. I'll see if it generates any free cash flow. I imagine it must generate some. So it trades at 58 times free cash flow. Again, even that will be slightly distorted because if they're reinvesting straight away into like marketing and sales or developing the product, even the free cash flow is not indicative of what it could be if they hit a certain scale and then stop doing that and just start returning cash to shareholders instead of just continually reinvesting it. But I think it probably actually wouldn't be just, do you know what I mean? Because it's that expensive and it's already a $27 billion company trading at 57 times free cash flow.
Yeah.
How closely would you look at it? Because you're not going to.
Yeah.
I'd be very surprised if you took a position in a business with those kind of metrics.
No. Well, thank you for pulling them up anyway, Sam.
That's okay. So Sage looks more reasonable though in comparison.
It's the value play. It's 32 times.
It can be second in that industry. I mean, it might actually be number one. I don't know which one's number one or number two. In the UK, say Sage probably is number one, I'd have thought still. But say it is number two once everything's gone over to cloud and stuff. You can still do very, very well as number two. It's like Pepsi. They still make loads of money. Very investable business still.
And you look at historically since it listed, wow, it's done incredibly. So it listed in 1990. And
UK tech stock.
Yeah, it is basically 37 bagger.
There you go. UK tech success. Should we move on to a business that is a lot less sticky?
Yeah, no, absolutely. And it's basically been destroyed by technology and the internet, I would say. But that's TUI, the travel group. We've covered them before. It operates a number of travel businesses, including owning an airline, cruise ships, hotels, resorts, and serves over 20 million customers across more than 180 destinations. They had their second quarter results out, with second quarter revenue rising 1.5% to 3.7 billion euros against the 3.8 billion euros expected, and that was driven by higher prices. Underlying operating losses widened by 18 million euros to 207 million euros, compared with the 224 million loss expected. There was a 32 million euro negative impact from Easter being later this year and falling into the following quarter. Strong growth in cruises was more than offset by declines in other divisions, largely due to late timing of Easter. Underlying free cash flow rose by around 100 million euros to 1 billion euros in the quarter, and net debt improved by around 100 million euros to 3 billion year on year. Despite some softness in the bookings in Germany, full-year guidance has been reiterated, and revenue is expected to increase by between 5 and 10%, and underlying operating profit is expected to grow by between 7 and 10%, and the shares were down nearly 10% in early trading. In terms of valuation, TUI has a market cap of 3.45 billion euros and trades at 5.9 times forward earnings, compared with the 10-year average of 6.7, and it doesn't pay a dividend. As I mentioned before, I think it's in an incredibly competitive sector, and when you've got websites like Skyscanner, Booking.com, Airbnb, Trivago, all of that sort of stuff, I think more traditional travel operators, particularly when they're coming in with cruise ships, they own airlines, it's an incredible task, I think, to compete with those. And I think you're seeing with TUI, it's one of the few that's actually left over of the more traditional travel agents or travel groups, and it is struggling. It's, for me, as a sector with these kind of more traditional legacy operators, I do just think they're uninvestable. And the fact that it has some of those things in, like the cruise ships and airlines, puts me off even more. And then add on top of that, staffing costs. I don't know, they're much slimmer than they would have been historically, but again, it makes them less competitive, particularly in the UK when you've got national insurance hikes, etc. So yeah, I think at any price, it would probably be too much for me. And I don't think I have much more to add than that. Sam, what are your thoughts?
I'd also consider it uninvestable just because of the industry. That being said, even within the industry, I think it's quite unattractive. I think it's quite interesting though, because when you look at it historically, we keep seeing all these losses, but then there's free cash flow. Then you go in and you look why, and the reason is because they've got huge depreciation. As we talked about with Auction Technology Group, you don't actually have to pay the depreciation. It's for an asset you've already bought. But the difference with Auction Technology Group, as we mentioned, was that at the end you're still left with this asset. Whereas with TUI, by the time they've finished fully depreciating these assets, you probably need to go out and buy another plane, or you probably need to go out and build another cruise ship. Whatever the expected useful life is expected to be for a plane, it probably is going to be about right before it becomes redundant. So although it kind of looks on the surface of these results like it's not terrible, I actually think they might have a huge problem building up because they are losing money. The debt's not great, but then they've still got all this capex they need. And they are in trouble, I think. I mean, the capex has been reasonable in the last few years, but yeah, it's less than the depreciation, which just seems a bit odd. It means that they are investing less than they have historically, would be my interpretation of it without really digging into the detail. And it might in the short term help free cash flow and you might get away with it for a while, but at some point they're going to need to go out and potentially take on even more debt, which they can't really afford to do. But I'd consider it uninvestable anyway. But yeah, it looks, I think, quite concerning because of the debt levels. And that's with what on the surface looks like probably lower than normal capital investment. And it's a very, very capital intensive business, I think, what they're in really, because you need to go out and keep getting new planes and stuff. So yeah, uninvestable anyway, but even within the industry, it doesn't look like it's in great shape.
On to a favourite of the show.
Yes, Upwork, and one that we both own. So for anyone who's not familiar, Upwork, it is a freelancing platform. So it allows contractors to find people who want to work remotely on basically anything you can think of, really. And Upwork takes a fee for kind of introducing them, basically, and then they can do the work via the platform as well. They've got you can put the funds in escrow, so it gives them a degree of protection, with the hope being that they'll continue to work via Upwork instead of taking the services off the platform. So Upwork have come out with the first quarter results, and revenue grew 1% to $192 million. Active clients was 812,000. Gross sales value per active client was up 3% to 4,912. That reflects positive growth for the first time in 6 quarters. Net income was $37.7 million, and that was more than double net income of the previous year. Diluted earnings per share was 27 cents compared to 13% in the same quarter last year. Adjusted EBITDA was $56 million, and that compares to $33 million in the same quarter of last year. Cash provided from operating activities was $37 million, and that compares to $14.8 million a year ago. Free cash flow was $30.8 million, and that compares to $12.1 million a year ago. So if you just go off what they've put in their highlights, it looks like an excellent quarter. If you go into the outlook for the next quarter, it looks like more of the same. For the year as a whole, it looks more of the same. So on the surface, it looks pretty good. And then you go into the actual KPIs in the results, and the gross sales value, so the value of everything that was kind of bought on the platform, was down 2.1%. So they've managed to squeeze more out of a smaller number, but it's not really what you want. Gross profit was up 1% to 78%, so that's pretty good. Operating expenses were down 16% to 112 million, and maybe they can repeat that, but part of the reason these results are so good is because they've cut the expenses. Revenues kind of stayed the same, but that's just all gone through into extra cash for the shareholders, really. And the profit, that's why the profit margin, that's up from 10 to 20%, so a huge jump. Concerningly, the number of active clients is down 7% to 812,000. In the earnings call, the CEO was questioned about it, and they didn't seem particularly concerned. There was a question relating to the decline in user numbers, and the CEO, Hayden Brown, acknowledged it, but emphasized the resilience of the platform, noting that despite some macroeconomic uncertainty, clients still have mission-critical work that they continue to fulfill on Upwork. CFO Erica Gezer explained that while there were slight macro headwinds affecting customer activity at the top of the funnel, improvements in product features helped gross services volume per active client increase by 3%. Especially, they think they've attributed the decline in active clients to broader macro pressures. They kind of indicated they don't expect it to continue. My concern would be that based on what we've seen from following Fiverr for the last few quarters is that this could be the start of a trend. That being said, what we've also seen from Fiverr is that these businesses both seem to be now in a position where they're able to just turn on the tap of actually getting some earnings out of this revenue, and they're cutting a lot of the costs like the sales and the marketing and stuff like that. And they're actually switching their business towards focusing on making a profit instead of just growing the revenue. But it was kind of brushed off, but for me, that's quite a concerning drop. Hopefully it is just temporary. I think January to March, I don't think it's too soon to really blame it on tariffs or anything like that. So yeah, the market's reacted quite well to these results, but for me, they are quite concerning because it's just that drop in customers. I do not like it. In terms of the valuation, however, the business trades at a PE of 10.39, and that compares with price to free cash flow of 14. I think that's reasonable. I think based on the guidance as well, it's pretty reasonable, but I feel like when you look at the industry they're in and the amount of tailwinds that they should have going for them, I do think they should be doing a bit better actually, but this is the first quarter we've seen like this. But based on what we've seen from Fiverr, my concern is it's the start of a trend. What about you, John?
Yeah, I hadn't thought about it so much as the start of a trend. I thought it was, encouraging in general, but you do flag that up, and that slightly undermines my confidence, particularly given the market reaction to it. However, I do still think it's a growth, a strong growth sector. And for me, I've got both the Fiverr and Upwork. So I think with that basket approach, I would be optimistic for the sector as a whole. So hopefully what you're saying isn't going to be the start of that trend. But
find out in a quarter anyway.
Yeah,
so.
well, exactly.
So in that case, of the 6 companies we've covered this week, Imperial Brands, Auction Technology Group, Burberry, Sage, TUI and Upwork, which do you like the most, which do you like the least?
Easy in terms of last choice, it would be TUI. I think even I would hold out some hope for Burberry over TUI. And then my top pick, it would still be Upwork, but perhaps slightly less strong pick than it would otherwise have been.
I don't know if I'd go with Auction Technology Group.
I thought you might say that.
They're actually trading fairly similar prices as well, but I think there's a lot to like about it, and I think it's taken me 2 or 3 goes to figure it out. But fortunately, I don't think. Did you see what the Auction Technology Group share price has been doing in the time we've covered it? Yeah, that was the other thing with it. When it first listed, it listed at about £7.50 a share, went up to just over £15, and since then it's kind of slowly declined. So it's now at £5 a share. It's been even lower. It's been as low as 4, but yes, I don't think it's a bad business. But so I think I'm going to take a serious look at Auction Technology Group. So I think that's my top pick.
Very good. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.